Nilesh bhai, I look at the headline which has been thrown at us, and the headline is inflation, inflation, inflation. And yet, if I look at the market are climbing the wall of worry. Our old timers, and I'm not pointing towards you, Nilesh bhai, I know you're an old timer, but I'm really talking about the veteran old timers who track global markets. They are saying that inflation is the biggest challenge for equity market and we must not ignore it. The new age investors are saying this time inflation is different and we should look through it. So my question to you is that so far markets have ignored inflation, both local and global. Can we afford to do that? Is the inflationary pressure transitory? And is it time to look at this market with a different prism?
Nikunj, thank you for calling me over here. You have raised a very pertinent question. If we look at US Fed, when they get up on left side of the bed, they talk about inflation pressure. They talk about need to, tighten money supply and raise interest rates. They talk about withdrawing liquidity support, a quasi-taper tantrum. But when they get out on the right side of the bed, they start talking about need to support growth. This inflation will be transient and we will look through it. Clearly, Fed's dilemma is there for every central banker in the world. On one side, they have to support growth. On the other side, they also have to control inflation. And matters have become confused because governments have given massive stimulus. At one point of time in US, 42% of unemployed people were getting more money from government sitting at home than what they would have earned by working in McDonald's joint kind of things. So this massive stimulus created a demand, and obviously those stimuluses are not permanent. One day and very soon, those stimuluses will be withdrawn, demand will fall off, supply has been ramped up, and then inflation could become transient. Can the opposite scenario work out? It is possible. And which is where there is a little bit of confusion in the world as well as in India about inflation. Fortunately, in India, our consumer price inflation is staked with food, fuel, and housing. This component looks reasonably under control. It's the commodities where we have seen pressure. And fortunately, it looks like June probably has witnessed the top of some of the agri commodities and industrial commodity. Hopefully, as the stimulus gets withdrawn, demand will taper off and supply will increase and probably capping the price rise. Should RBI be vigilant about inflation? Undoubtedly, yes. Should they be unduly worried and take such a tight inflationary measure that growth gets derailed? Answer is no. Like in the past, they must balance between growth and inflation.
So how do you see equity market moving? Typically when inflation comes back, it's time to buy cyclicals, hard commodities, metals. That's one trade. Second is, if inflation is transitory, then you go on the other side, which is you buy discretionary, you start buying durables, you start buying autos.
So from the equity point of view, today what we have to look at is keep in mind in the same sense inflation versus non-inflation trade, or stay at home versus opening up of economy trade, or defensive versus cyclical trade. We believe at this point of time you have to build portfolio which is for opening up of economy. Our hypothesis is as under, with vaccination, ferociousness of the third wave will be much lower to second wave, and disruption of economic activities will be much lower. The corporate profitability growth which we have witnessed since September 2020 with minor disruption in June 21 quarter will continue because of tighter working capital management, cost control, and reduction in interest rate liability. There will be fiscal stimulus as this year the nominal GDP growth is likely to be much higher than the taxation increase in the budget. Put all these things together, we should see better economic days, and hence putting up trade which is, let's say, pro-inflation or opening up of economy or cyclical will be more appropriate.
Nilesh bhai, any bull market always has a leadership pattern. It was, let's say, consumer few years ago. Before that, it was a combination of largely in the 2003-2008 bull market, infra, metals and power companies. What is the leadership in this bull market? Because one side you've got PSUs which have made a comeback, and on the other side you've got Paytm and Zomato which are trying to go public. They both are extreme ends, but they are both existing.
So my feeling is that in this time's bull run, the leadership is actually with new age companies which is coming out with IPOs. If you see, we have probably seen one of the best run in IPO market where issues are getting subscribed hundreds of times. They are opening up at a reasonable premium to sometimes even existing players. So the leadership is definitely with new age companies and IPO markets, in the IPO markets or IPO companies. Now, is this sustainable? My feeling is that as of today, the unlisted equity market or private equity venture capital market is valuing companies on a much higher level compared to, let's say, listed companies. And when they come to the IPO market, we'll have to see whether listed companies' valuation get equalized to unlisted companies or unlisted companies' valuation get equalized to listed company. If the leadership of the market has to be with new age companies, then we need to see some bridging of gap between, let's say, private equity venture capital market and the listed market.
Okay. We've been looking at the entire reopening trade, Nilesh, and I just want to get your views on that, given some of the backdrop that we've just discussed, and particularly how this will apply to certain pockets, consumption, etc. Do you have that kind of conviction in the reopening this time? I mean, even though growth may take a couple of quarters to really kick in, expectations and estimates are being planned around a solid recovery this time around.
So, Ayesha, if we see the regional and rotational lockdown in the second wave compared to national lockdown in the first wave, created far lesser disruption to economic activities. It did impact economic activities, but it didn't impact as much as the first wave. So in the first wave, we saw GDP coming down by about 24%. This second wave, probably GDP growth could be still positive or marginally negative. From a ramp-up point of view, clearly, once the second wave started coming under control and opening up of economy happened, the activity levels have started normalizing pretty fast. Today, in the month of June end, activity levels are above April levels. If you look at from an unemployment point of view, in the first wave, unemployment went from about 6% to about 25%. In the second wave, it went up, but from 6% to 13%, and now it is back towards higher single digit. So whether we look at economic activities which are now at April level or unemployment which didn't rise as much as the first wave, and if you look at normalization of economic activity, everything is pointing towards lesser disruption and faster normalization. Does this mean that we don't have pain points in the economy? Answer undoubtedly is no. MSME sector, in our opinion, has been hit hard, and they will require some sort of nurturing and support.
Okay. The broader markets and the kind of action we saw picking up there, and I see the resulting returns in some of your funds as well, have really been encouraging. Do you see this trend continuing? Is it sustainable? Do you see interest building in some of the quality companies in the larger universe now? Vis-a-vis the index, how do you really see the trend panning out?
So this is one question which is dividing the market. The small caps have delivered double the return of large cap in last one and quarter year. Mid caps have delivered about 1.5 times returns of large cap. The valuation gap between large, mid and small has narrowed down considerably. There is one set of market participants who believe that now large cap will take the lead, and the rally which we saw in small and mid cap will start getting consolidated. On the other hand, there is a set of market participants which believe that even now quality mid caps and small caps will show better earnings growth, and hence their valuations are not truly reflective of their growth potential. Now, this is where we are seeing a division in the market. There is no clear view. At this point of time, we believe there will be few small and mid-cap stocks where earnings growth could surprise the market, and hence they will deliver better returns than the large cap. But across the entire basket of small and mid-cap, that looks difficult. Valuations in small and mid-caps have been re-rated pretty well in last 1.5 years. At this point of time, we really don't have any preference over large cap, mid-cap, small cap. There's not much room for re-rating of small and mid cap in current scenario, except few stocks.
Sure. Nilesh, at a time like this, while you've talked about and highlighted your thoughts on both the large as well as the mid and small cap universe, where does debt lie in the piece of pie? And for mutual fund investors, what should be the exposure to debt in their portfolio?
So essentially, the short end of the curve has been doing reasonably well for mutual fund. That's where we have seen steepness of interest rate movement. The interest rate movement has been calibrated by RBI's intervention. US interest rates on 10-year benchmark went up about 3 times from the bottom. Indian interest rates are exactly where they were. So that's a commendable job by RBI in managing government's borrowing program and keeping interest rates at the same level. Now, this does create opportunity for dynamic bond fund managers who can play this interest rate volatility to generate return. So for debt investors, if they want pure safety, short end of the curve provides better opportunity from short-term bond fund, corporate bond fund, PSU debt fund. They will have less impact of rising interest rates. If you believe in your fund manager, then dynamic bond fund does provide good opportunity. All these funds have delivered near higher single-digit return over last 3 years. And while rising interest rates will pay some amount of return, but if you take a 3-year view, this fund should be able to do well.
Sure. I asked because debt has found minuscule exposure in most portfolios, at least in the last year and a half. Nilesh, also you were sharing a very interesting anecdote just the other day, talking about how Koreans responded during the Asian crisis and how gold came to their rescue, much like the stories that we've heard during our own independence struggle. Do you think the solution to our crisis right now lies in gold by any chance?
Undoubtedly, Ayesha, and thank you for bringing that tweet. For the viewers, Koreans donated their gold during 97 Asian crisis, and the government was able to raise about $2.5 billion worth of precious foreign exchange savings. Our problem is leaking bucket. We desperately go abroad to attract foreign direct investments, to attract foreign portfolio investment. We lay a red carpet for foreigners to come invest in India. However, when we get that money, we end up spending that on import of gold. In last 21 years, Indians have imported on a net basis about $373 billion of gold, excluding gold smuggling, excluding jewelry which is worn by travelers when returning from abroad and who walk past Green Channel. If we take a rounded off number, that's about $500 billion. It's more than the foreign direct investment we have received. It's more than the foreign portfolio investment we have received. It's probably just little less than the combined FDI and FPI which we have received. If through a miracle, India was not importing gold, India was not sending this precarious foreign exchange abroad, then that $500 billion in just last 21 years would have been invested in building healthcare, in building hospital beds, in providing oxygen concentrators and oxygen plants, in building roads, schools, colleges, and so on and so forth. This $500 billion of savings which has leaked out in just this century could have really impacted India's growth. So I believe we as Indians need to reduce our obsession of gold. We need to monetize our existing gold holding, which is the highest in the world. Unfortunately, bulk of our gold holding remains in tijori, in black market, in black economy. And we need to ensure that that frozen saving, which is lying in the tijori, comes into the main white line economy. Gold financing companies are doing a great job in creating liquidity out of that gold, but we need to do it on a much larger scale.
Okay, Nilesh, we've covered such a wide spectrum of, ways to invest or strategies to take in the markets right now. If I had to ask you one way to get rich, we ask all our experts this, to try and get some nuggets of advice for the young investors out there, what would it be?
So my immediate answer will be invest in Kotak mutual fund, but that's like asking a barber whether you need haircut or not. I have actually 3 advice for investors to become rich. One, be a long-term investor. There is a proverb which says that you don't expect mango before 12 years. The same way, you have to create wealth over a period of time. Second, be a regular investor. Little drops of water make an ocean. All the little savings which you do by avoiding, one outing at hotel or restaurant will go a long way in building a good retirement corpus. And third, follow disciplined asset allocation. You don't put all eggs in one basket. Same way, you don't put all your investments based on the past performance. Whatever is given 100% return in last 1 year, chances are that in next year, they are not going to give 100% return. So be a regular investor, be a long-term investor, and be a disciplined asset allocator. This is good enough for you to become rich.
Sound advice coming in from Nilesh Shah this morning on how to perhaps look at your investing strategy. Okay, we've talked about the variety of opportunities in the market, but on the index itself then, Nilesh, what should we anticipate? I mean, is it too soon to factor in a year-end target, given that we are still a little uncertain about the next few months? Or given how bullish everyone seems to be, is a year-end target completely doable?
So when there is consensus, there is always risk. Markets have always surprised consensus. But at this point of time, we maintain equal weight allocation to equity. Markets are not cheap like they were in 2020, March, April, May, June 20 period. And markets are not very expensive either. It's pricing in risk and reward. It's pricing in hope and fear. There will be some amount of consolidation at current level. So maintain equal weight allocation to equity. take the ride of volatility on your stride and try to take advantage of that by buying into correction if it comes.
Sure. It's not a metaphor, but I know you're into spirituality. Imagine if you have to go on a 3-year break and you're allowed to invest once before 3 years. What is that one trade you would like to do before you go for 3-year break?
If I have the luxury of not looking at my portfolio for 3 years and build it today, I will go and buy industrial stocks. These are the stocks which are for last 5 years. These are the companies which for last 5 years have seen, very, very subdued capital expenditure. Now we are seeing revival of capex across the world. Mother of big wave on infrastructure and capital expenditure is coming around the world thanks to the government stimulus. There will be export market for capital industrial equipments. There will be local markets for capital industrial equipments. Today, commodities like cement steel are running at the top end of their capacity utilization. Pretty soon, there will be plans for spending or incurring capital expenditure on this. Now you have a very good combo of next 3 years where companies have become fighting fit because they had to survive in a very, very tough last 5 years. And they are going to get volume expansion in local market as well as exports market. So if I have to play for a 3-year game, I will buy quality industrial stocks who have export presence as well as local market and sleep over it.
You don't go for a 3-year break because I always look forward to our engagement and our interactions. So hope to see you very soon. Well, certainly before next 3 months and next 3 weeks once again.
Thank you, Nikunj.